how an investment strategy would change for older investors compared to someone that is young. I'm going to explain that very short or very quickly, as quick as possible, and simplify things as much as possible from my personal experience. Now, obviously, I believe I'm still a somewhat young investor. I'm 32 years old. Many people start out there, they didn't, unfortunately, they don't start sometimes as young as I did. Many people are starting to build their portfolio at the age of, as an example, 50 or 55 or 60 or whatever it is. Now, it depends what, the word older investor, that I guess has to be more identified depending on how old that person was, whether they're 50 or 60 as an example. Some people think 40 is old. Now the older I get, I think 40 is still young, but that's just what happens when people get older. A few different key considerations would be, maybe they wouldn't buy, number one, they wouldn't buy as many properties. Instead of aiming for, let's say, 20 properties, maybe they would only aim for 7 properties or 10 properties. So one thing would change, I would say, would be the volume of property or the amount of debt that a person takes on. So if I was starting again, let's say I was 30 years old as an example right now, starting from day one, realistically from a long-term perspective, let's say hypothetically in this scenario, a person's going to work to the age of 65. I think the retirement age is probably even further older than that now, but then technically if I'm 30 years old, then I've got 35 years technically of working years if a person did hypothetically retire at 65. So I've got 35 years remaining. So generally, when you're younger, then is the time to be able to take more risks, invest in more property, maybe do higher loan to value ratios, put down smaller deposits, and because you've got more time to recover should anything happen. Of course, it's not saying being silly about it, but you've got more time, so you can put a goal as an example to buy 20 properties in the next 10 years. Whereas if a person's starting at the age of 50 and they've only got 15 years, well, maybe it's not 10 properties, maybe it's only 5 or 7 properties. So I would be scaling back maybe the volume just to be a bit more conservative. Obviously, this is not financial advice, but I'm not a financial advisor. This is purely from my experience with buying over 80 properties myself and buying thousands for clients and all the property investment experience that I have. So the amount of properties that I would buy would probably go down for number one. Another way to be more conservative, I would say, would be to do bigger deposits, maybe do 20% compared to doing a 10% or a 5%. So doing bigger deposits. They would likely at that age, whether it's 50 or 55, if they're just getting started, they may be able to invest through what's called a self-managed super fund, compared to if someone's only 20 or 30 years old, they probably wouldn't likely have that much money in superannuation. But if someone is, as an example, 50 or 55, they would, assuming they've been working since the age of they were 20, so they've been working for 30 to 35 years, they would likely have a couple $100,000 at least, hopefully more, in super, which they could then use as a vehicle as deposits to buy more properties using the SMSF. So if they had 300,000 super, they could split that up into 300K deposits and leverage that into real estate, so that if they were going to continue working from the age of 50 to 65, and if they're trying to build up that nest egg hypothetically between 50 to 65 over 15 years, well, then they've owned, let's say, 3 properties, which in that 15-year period, the loans are going to go down. Let's say in year 15, as an example, the loans might be 30% or 40% paid off. They might not be 50% paid off, because that's not how loans work. They go on a sliding scale. But let's say, they've managed to buy $1 million worth of property, and then that 15-year period, because they leveraged that 300,000 into $1 million, that million hypothetically would have turned to 2 million. So now they've got 2 million worth of assets, but their loan might be 600,000. So they've got 1.4 million in net equity. Definitely, if it was me, look more into investing, utilizing a self-managed super fund. If I was starting off, if I was at age 50 or 55, or especially 50, depending on that person's scenario or how much equity they have in their house, but I would do both. One would say you need to be a little bit more aggressive if you've got a shorter time frame, but also you've got a shorter time frame should anything happen to actually recover from that. So it's important, of course, to always invest with the 3 strategies, which is buying under market value, buying with capital growth, and buying with a strong rental yield in a metro area as well. Those are 3 to 4 tips. I hope that helps. Keep the questions coming, and thanks for watching this video. Bye.